What is going on, YouTube Nation? This is Darth Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So I found a cheap dividend stock for you guys. We're going to do a review, and we'll see if it's a major risk, and we'll see if it's worth it. It's really cheap right now. A lot of you guys wanted me to do a video on these guys. So if you're new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. Smash that like button. And let's check this stock out right now. That stock is DHC, Diversified Healthcare Trust. It's sitting at 99 cents. It's less than $1. So in the past 5 years, it's down 94.71%. Its dividend yield is 4.03%. PE ratio 0.58. Volume 2.10 million, market cap 237.59 million US dollars. Year range is 97 cents to 398. Its day range was 97 cents to 109, and its previous close was 108. So let's check these guys out. So DHC is a real estate investment trust that owns approximately 6.9 billion of high quality healthcare properties located in 36 states and Washington, D.C. They seek to diversify across the health services spectrum by care delivery and practice type, by scientific research disciplines, and by property type and location. DHC Life Sciences and Medical Office portfolio includes over 100 properties, totaling approximately 9 million square feet, and is occupied by almost 500 tenants. DHC's senior living portfolio contains more than 27,000 senior limits. So let's look at a few things. So their real estate platform focused on the diverse spectrum of health sciences. So with their $6.9 billion investment portfolio, DHC is one of the leading owners in real estate located throughout the United States, focusing on healthcare and life sciences. DHC seeks to acquire and own properties that take strategic advantage of demographic trends, investments in biological breakthroughs, and development and implementation of medical services and technologies. So they're diversified across care delivery and practice types. Their properties provide platform for healthcare delivery, nationally renowned health systems, as well as individual specialist physicians and health practitioners lead DHC's properties with house clinics, outpatient centers, surgery centers, and doctors' offices. DHC is also poised to benefit from changing demographic changes, with a portfolio of more than 250 active adult independent assisted living and memory care facilities to serve the anticipated silver tsunami. So their life sciences properties include laboratory and research, manufacturing facilities, and corporate offices, and are home to forward-thinking companies delivering and supporting development of tomorrow's cutting-edge therapies, which include a wide variety of ailments. All right, so they're diversified. So they have approximately, let's see, the foundation of DHC's solid financial profile includes revenue sources lacking concentration in any property type, a well-laddered lease expiration schedule for approximately 500 tenants, strong tenant credit profile, and conservative capital structure with a healthy balance diet. I'm trying to hold my laugh. Diversification of DHC's revenue streams allows the company to produce cash flows from the entire healthcare continuum, leading to more stable and predictable returns on investments. And I'm going to tell you why I'm trying to hold my laugh, because we're going to go a little bit further into these guys. Let's go over their portfolio. In Florida, they have 9 medical office buildings, 32 total senior living communities. California, 12 senior living communities, 3 medical office buildings, life science, 10 of them skilled nursing facilities. Texas has 13 medical office buildings, senior living communities, and they also have wellness centers, which is pretty cool. So that's pretty nice. I like that they have wellness centers. So let's check that out in their map, because I do believe that certain facilities in is important. So, health and wellness centers, I think they're a lot better. Medical fitness facilities, I used to work at one in Akron, Ohio, which was the #1 medical fitness facility. It was a hospital owned, so the hospital has a gym, and it's actually pretty strong still. I went to visit there a few years ago, and I'm like, man, did they really deck it out. So we have their properties. So I'm just clicking around, looking at a few things. Now let's check out their revenue. So here's their revenue in millions US dollars. 2015, 998, 2016, 1,058, 2017, 1,074, 2018, 1,117, 2019, 1,040, no pandemic there. 2020, 1,632, and then 2021, 1,383. So there's some things that raise a flag. Operating income in 2020 is minus 12.857, and then 2021 minus 31.15. So that's a problem. That is a huge problem with the operating income being negative. So let's look at a few more things. Something is not right. So the stock price has gone down. Now, they did take a huge hit. Don't get me wrong. But in the past 20 years, their stock price has gone down. So something's not right. Their dividend payout was high. And then it's gone down. 2019, look at this. Right here, 2018, down. 2019, it's down. In 2020, way down. So something's not going on. They were doing really good, and then boom. And then their dividend yield, high dividend yield. So you got to watch that. So something's not right. The trends are not good. So that's a huge red flag for these guys. Now, risk-wise, I have, done a risk on these guys. I'll go over their dividend history in a second. But stocks like this, like IVR, that's where I put like my play money in, okay? Because it doesn't matter. Whatever happens, happens. That's kind of like putting money in Dogecoin. Like, it's just, I'm not expecting it to go crazy. So these guys have some issues. Less than $1. And would I take a risk on these guys? Again, this is not financial advice for entertainment purposes, only disclaimer in the description. That would be an experiment. And maybe I could, do something later on. But I wouldn't be banking on this thing, having a lot of promise and a lot of potential. I mean, I could do an experiment, show you guys how things are going. But the stock price has gone down significantly, and the dividend payout has decreased. Something's not right with these guys, and they got a lot of problems. It appears that they have a lot of problems. I'm not even doing any digging, but when you see this dropping significantly, something's not right with the investors. That raises a red flag. That's where you need to do your due diligence, and it does not look good. It's less than $1. I mean, IVR is kind of understandable because it's a mortgage-backed real estate investment trust, and it took a hit. So they're kind of in damage control. That's a mortgage-backed REIT. This one is a healthcare real estate investment trust. There is no excuse to suck this bad. I'm just being honest with you. These guys are in damage control. Potentially, they may have to do a reverse stock split to get people's attention. But they look terrible. I mean, they look awfully bad. Something is not going on here. And this isn't even like, look, 2018, it was 14, and then it dropped 2019, and then it dropped to 752, and then it just got boom when the pandemic hit. There's just not a lot of confidence in these guys. I mean, I read some articles that debt was an issue with these guys. Much better healthcare REITs out there than these guys. I mean, this is one maybe that I could buy 200 shares and see what the hell happens, but I really don't feel confident in these guys with this price going down. And now I'm going to go over their dividend history. So at one point in the 2000s, there was a lot of stability with these guys because there were dividend hikes at 31 cents to 32 cents to 33 cents in 2006, and then 2007, then 2008, 35, and then 36, and then 37, then 38 in 2012, and 39 cents. And then all of a sudden it got stagnant. 39 cents. There could be a management issues. Then we got a problem. 15 cents. Then we got another problem. Pandemic hits. 15 cents right here. 39 cents, 15 cents before a pandemic hit. Then it cracked 1 cent in 2020. So they're in damage control. It does not look good. It does not look good for these guys. They are in complete damage control. There's probably a dividend cut. I don't even have to look even further. There's probably a dividend cut for them to try to, help out with their debt that they're in. There's just a lot of problems. So I don't feel very confident in these guys. Probably at most I'd ever throw is 200 in. And again, I'm not giving financial advice for entertainment purposes, only disclaimer in the description, and I'm not pumping a stock. I just am really surprised at a healthcare real estate investment trust. Sucks, it's bad. So I'm just being clear with you. It just doesn't make sense. And it's not something that's like, understandable. It's unacceptable, and there's no excuses to be this bad if you're a healthcare REIT. I mean, people are getting sicker. People are getting sedentary lifestyles on the rise. I mean, this doesn't make any sense. I mean, over time, just getting killed. So I'd like to see these guys in the future and see how they do. I mean, I really like the healthcare REITs, but these guys are right now a complete embarrassment, and I got better things to spend. I like dividend hikes. I like better dividend growth stocks, especially healthcare REITs. Let me know what you think of this video. If you are new to this YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. This is Start Dividend. You guys have a good one.